You think you're getting paid. You think your salary is yours, earned, deposited, and ready to use. But what if I told you? The number you see on your payslip is only the starting point of a long, engineered system designed to drain it before you ever touch it. What if the real reason your money disappears so quickly has nothing to do with your spending habits and everything to do with invisible financial funnels operating behind the scenes? Funnels created decades ago. Funnels backed by institutions you trust. Funnels so normalized that you mistake them for just the cost of living. Today, we're exposing them. Not the obvious ones you already know, but the hidden structures quietly siphoning income from millions of people every single month without them ever realizing it. This is the story of how your salary became raw material for a financial machine and how that machine grew so powerful that escaping it now feels impossible. Stay with me, because once you see the full picture, you'll never look at your paycheck the same way again.
To understand how salary drainage became the norm, we have to step back, way back. The modern salary system wasn't built around empowerment or economic freedom. It was built for predictability, control, and debt expansion. In the early 1900s, most people were paid in cash at the end of each workday. There were no credit cards, no auto-pay bills, and definitely no algorithms tracking your spending. But as governments and banks expanded, they needed a stable, predictable flow of money from workers, something they could measure, tax, lend against, and profit from. That's when the first quiet shift happened. The salary went from being your money to being their baseline for systemic extraction. By the 1950s, major financial players discovered something. If they could predict your income, they could predict and ultimately control your spending behavior. Then came the twist that changed everything: the rise of automatic deductions and revolving credit. They didn't just reduce your paycheck, they rewrote how you experience your own money. We're about to break down exactly how, because each of these shifts didn't happen by accident, they happened by design.
It began with two simple innovations: withholding taxes and employer-tied benefits. 1. Withholding taxes, the first silent funnel. Before 1943, Americans paid taxes once a year. It was painful, noticeable, and unpopular. But during World War II, the government faced massive funding needs. Their solution? Tax the worker before the worker ever sees the money. It was sold as temporary. It became permanent. And it created the very first invisible salary funnel, a system where money leaves your pocket without your involvement, consent, or awareness. People didn't protest because they never felt the loss directly, and the financial system took notes. 2. Employer benefits, the illusion of free money. Companies discovered that offering health benefits and retirement plans didn't just attract workers, it locked them in. Your salary became entangled with corporate-controlled financial products, employer-managed pensions, insurance premiums, retirement contributions you can't access, benefit fees baked into compensation packages. Each one a funnel. Each one extracting value before you even receive your paycheck. But this was only the beginning.
By the 1970s and 80s, the financial world made a discovery that changed everything. If people had predictable salaries, they could be given predictable debt. Credit cards exploded, auto loans became standard, student loans ballooned, mortgage lengths stretched from 15 to 30 years. And every loan came with something the banks loved: automatic monthly payments tied to your salary cycle. This innovation turned your paycheck into collateral. It didn't matter what you spent on. The system was already designed so that money would be extracted from you the moment it entered your account. Then came the quiet masterstroke: minimum payments. Credit card companies realized they could make far more money if you remained in debt for 10 to 20 years rather than paying it off quickly. Minimum payments were engineered to look manageable, but strategically designed to maximize interest. A revolving funnel, one that never closes.
By the early 2000s, financial funnels were everywhere. Rising cost of housing, exploding insurance premiums, subscription-based everything, predatory lending, wage stagnation, inflation outpacing earnings. People weren't living paycheck to paycheck by mistake. They were living paycheck to paycheck because the system benefits when they do. The breaking point came when wages stopped rising while extraction mechanisms continued accelerating. It wasn't a coincidence, it was a structural inevitability. For the system to work, workers must borrow to survive, spend to keep the economy moving, pay interest to maintain the financial engine. Stay dependent on credit. Your salary, just fuel. Your debt, their profit. Your financial stress, a predictable input in their economic model. As the system grew, something unexpected happened. People began working harder while falling further behind. This wasn't a personal failure. It was the result of a new problem. The funnels became more powerful than the workers feeding them. Consider the fallout. Real wages flat for decades. Median rent now consuming 30 to 50% of income in many cities. 60% of Americans unable to cover a $1,000 emergency. Average credit card APR exceeding 20%. Household debt reaching historic highs. Workers aren't overspending. They're being outpaced by a system calibrated to drain faster than they can earn. Every funnel pulls a little. Together, they create the perfect financial storm. And yet, the system offers solutions. But those solutions don't fix the problem. They reinforce it. Here's where things twist again. Nearly every financial reform in the last 30 years has made the system more profitable for the institutions running it. Examples. 1. Adjusted minimum payments, framed as helping consumers manage debt, actually extended repayment periods and increased total interest. 2. Expanding credit limits, framed as improving financial flexibility, actually deepened reliance on revolving debt. 3. Student loan restructuring, framed as affordable education access, actually turned higher education into a trillion-dollar debt industry. 4. Retirement plans shifting from pensions to 401ks, framed as giving control to workers, actually transferred market risk from corporations to individuals. The fixes didn't fail by accident. They failed because success was never the goal. The goal was continuity of extraction.
If you think the draining has slowed down, look again. The funnels have simply evolved. Subscription economy. What used to be a one-time purchase is now a monthly financial siphon. Software, entertainment, fitness, education, food delivery. Each one small, each one continuous, each one timed perfectly to salary cycles. Buy now, pay later. The newest form of disguised debt. Marketed as harmless, yet designed for maximum dependence. Dynamic pricing. Algorithms that raise prices based on your behavior. Your salary becomes a target, not a protection. Invisible fees. Bank fees, service fees, convenience fees. A billion-dollar industry built on micro-extractions. Inflation masking. Numbers rise faster than salaries, and the system calls it normal. These aren't coincidences. They're modern upgrades to an old machine. The funnels are still draining your salary. They've just gotten smarter.
3 clear takeaways. 1. Your salary is not a reward. It's a variable in a larger financial equation. The system knows its value long before you receive it. 2. Debt is not an accident, it's the engine. The modern economy depends on workers staying indebted and dependent. 3. Financial freedom requires stepping outside the funnels, not navigating within them. Budgeting helps, saving helps, but true change comes from understanding the extraction mechanisms and building strategies to reduce exposure.
The funnels are expanding, not shrinking. Automation, subscription models, algorithmic pricing, and rising global debt mean the next decade will intensify salary drainage for anyone who doesn't learn to defend against it. The system isn't slowing down, so you can't either.
If you want deeper breakdowns like this, strategies to protect your income, and step-by-step guides to escape financial traps, subscribe, turn on notifications, and stay with this channel.